G'day everyone, welcome back to Pete's Investing. Today we're looking at the Stochastic 200-100 strategy. So what I've done here on the hourly chart, this is the Nikkei Japanese share market index. So the way it works is, first of all you configure the Stochastic to a 200. Let me show you the configuration. It's 200K, 100D smoothing and 50 smoothing period, and that's a slow period there. So the way it works is, if you look at this little trade here, these blocks up here indicate the number of times you entered and exited. So this is the entry and exit. So if you look at this trade here, this is a lot going long. We entered long. Let me drill down on that a bit more. We entered long. When the Stochastic here, the Stochastic K 200 crosses over the Stochastic D, we enter long, and that's got to be below the 30 bar, the 30 mark. So when it crosses over and it's below the 30, we enter long. And we hold that. Now the price has dropped against us, it's going sideways, and it eventually rises, and it closes out there. And we close it out once we've reached at least a 5% gain, and the Stochastic K drops below the D line, which it does there. So it's gone beyond there. Let me just draw a ruler in terms of the percentage gain made. So from that entry, oops, let me do that again. Bear with me 1 second. So so you can see there, it's made a 6% gain in that period. So I want to make at least a 5% gain before we exit the trade. Another long entry here. You can see there, it's the Stochastic K is below the 30 mark. We enter when it crosses over. You can see there it entered at 28,505. We didn't exit there because that wasn't a 5% gain. And again, just to prove that with the ruler, from that entry to there, it's 1.4%. It exited there. We gained close to 5%. It was about 4%, and the K drops below there, and it's above. That's got to be above 70. The 70%, the 70 marker on the Stochastic. That's where we closed the trade at that point. This also works in the reverse in terms of going short. You can enter the trade going short. So again, when it's above 70 and it crosses down below there, below the 70 mark, we enter short, and we exit when it crosses above the 70 mark. At that point, we close out the trade, and again, that's got to make a 5% gain in terms of the profits. In terms of moving averages, in terms of averaging down, remember we don't use stop losses. That's a sure way of losing money. There's certain ways of trading the average down approach without losing money. So one way we do it is we make sure we've got enough money in the balance to allow for any drawdowns. But in terms of the averaging down, you can see we entered a trade there going long. The price drops down, rises a bit, didn't rise far enough for our 5% gain, 4-5% gain. We're looking at the long strategy here. Go sideways, enter another long entry there. Now the entry for the second long, that must be less than the initial entry price, which it is. Then the price eventually rises and we close out. Now the reason we closed out there, because the new average price is now somewhere in between that point and that point. That's going to be the new average price around there. And that's gained a 5% gain from our average, and we close it out when the Stochastics cross. That's our averaging down approach. The same thing works in reverse for a shorting position. We enter short, price goes against us, we enter our second position, that's now higher than our initial entry, goes in our favour, drops far enough to about 4-5%, and we close it out. So how does our program compare to the other programs tested in the past? So this is our program tested today. Let me highlight that to make it a bit more obvious. So that's that point there. That's our revenue generated, and we're testing against these indices. And these are going for long, in a long position. That's our revenue generated, so 25,000 is the total for those 6 indices traded. This is our drawdown on those 6 indices. So the drawdown is from the highest point of profitability to the lowest point. So again, just looking on the chart, the drawdown from a given period of the trading period, you find the highest point of profitability. So let's assuming that there would have been the highest point of profitability down to there. That's considered a drawdown. That would have been the highest point, or it may have been that point there. So that is considered the drawdown. And then lastly, we look at the profit over drawdown percentage, and that's a total of 195 in terms of profit over drawdown. So that ranks 17th overall amongst our programs tested to date. You can reference some of these other programs we've tested in the past from my previous videos. Here are some of my investing rules: buy proven blue chip stocks, buy stocks which pay dividends, don't short positions, go long only. And the reason for that is you want to receive those dividends when they're paid, and don't trade on news. Prices are already factored in the share price. Thanks for watching. Don't forget to hit the subscribe and the like button. Click the notification bell to get all updates to the channel. If you want to support the channel, subscribe to the Patreon page. The link is in the description below. Happy investing, and speak to you in the next video.